PR Connections Radio presents Ethics Realty is a full-service real estate agency that provides a service for finding the ideal property for residential, commercial, and investor-centered clients. Whether you're a first-time buyer or a seasoned buyer or investor, they provide service to all and listen to understand your goals and needs. For more information about their wealth and investment-centered services, call 702-518-1606 or visit their website, ethicsrealty.net.
All right, welcome to the Real Deal Podcast. I'm your host, Davin Sundvick, and today what we're going to be going over is how to win financially in 2026. You see, we got Christmas coming around in just a couple of days, and a lot of people are going to be focusing on the holiday season, which is fantastic. But the real winners who are going to be getting wealthy in 2026, they're going to have their mindset on what they need to be doing in their personal budgets and in their financial portfolios in order to get ahead. So there's a couple of concepts I want to cover today. And if you've never done a budget or you've never looked at your budget, one of the first things that you're going to have to understand about budgeting is understanding a cost benefit analysis. You see, we do this in business all the time to determine which financial assets we should be investing into as a business owner in order to improve our profitability. And essentially, operating your personal budget has its own profitability as well. You see, you've got liabilities, which you want to be able to reduce as much as possible, but we don't want to chase after this too much. There's a limit to how much we can reduce our liabilities. At some point in time, we also have to increase our capabilities as well. But reducing liabilities is incredibly important. When you do both, that combination creates wealth. So, first step to understanding a cost-benefit analysis is you have to be able to identify needs versus wants. It's really easy to save money on wants, but remember, these savings are unnecessary anyway. So for example, if you go out and drink coffee, right, at Starbucks, you spend $7 on a coffee for 30 days, that's about $210. So if you buy a coffee maker for $100 and you spend maybe $50 on a quality pound of coffee for the month, you might say, hey, I saved $50. No, you didn't really save $50 because coffee isn't a necessity. So you have to identify needs versus wants when you're doing a cost-benefit analysis. And you always focus on your needs first. So that's step 2, is put all the focus on the wants on the back burner until there's enough extra cash that's accumulated to pay for them. Essentially what that means is you got to prioritize those needs first. Step number 3 is identify the need that has the most room to be reduced first. Now, sometimes this is a little bit difficult. So in step 6, we'll essentially redo this process, which will kind of help us organize our needs. Step 4 is to identify the cost of any of the tools that are used and ongoing expenses of this more efficient process that's used to fill the need, right? So there's a lot of different needs that we have as people, right? We all need to eat. We all need to have housing. We all need to be clean, right? So we all need to process our clothing, and we got to shower, and we got to do all these things, right? We got to figure out the most effective way to get all of these systems managed. And then step number 5, what we're going to be doing is using the following equation. The estimated replaced expense, which is just simply, if you look at your history in your finances, you look at the last 12 months, you say, hey, how much has it cost me to get this particular need filled? Then what we're going to be doing is we're going to be subtracting the new expense from that. It's very simple, right? And then you're dividing that difference by the cost to change the system, right? So you might be, let's just say you don't have a washer and dryer. So you're going to the laundromat, right? That would be an example of a cost benefit analysis that you could do. I'm going to give you 2. And what we're going to do is prioritize them at the end here so you kind of understand how to organize your budget for a year, right? And this might not apply directly towards you. You would look at your own budget and find out a list of things that you think you need to change your systems on and take a little bit more control over and kind of possibly reduce some of your expenses. First example is buying a water filtration system for $300 to replace a $16 a month filtered water expense and the inconvenience of carrying 5-gallon jugs. I don't know if you've ever had tap water in an apartment or a place that didn't have very good tasting tap water, but carrying 5-gallon jugs is not convenient at all. So that's also like an additional benefit to doing this system, right? The replacement filters typically for a water filtration system is about $100 a year. So what we do is we take 16 times 12, you get 182, subtract out $100 a year in filters, divide that by $300, which is the cost of your filtration system. And what you get is a 27% return on investment. That's not too bad. It means that you'll get your money back in roughly 3 to 4 years, which isn't terrible. But let's look at example 2 here, right? And this is actually 2 examples of something that I installed in 2025 into my personal home. Is I bought a $150 pressure canner, right, and $25 worth of jars to reduce $100 a month in food waste. And the average American actually wastes about $120 a month. So it's about $1,500 annually, right? So replacement lids cost about $12 a month for my particular needs. So you take $1,200 minus $144, right, annually. Divide that by $175, and you get 603%. That's phenomenal, right? But this is why we can't just chase liability reduction. At the end of the year, that pressure canner that's used is worth nothing, right? At the end of the year, that water filtration system is worth essentially nothing, right? It doesn't build my assets at all, right? It just reduces some of my expenses of running my household. So the decision is buy the pressure canner first, use the cost savings, buy the water filter later on in the year, right? And by the end of the year, I would have saved hundreds and hundreds of dollars still, right? So that kind of helps me build my budget out to know what my year is going to look like when I already know where some of my cost savings are going to. And you always want to build your cost savings into the beginning of the year, right? So if you need a tool that you're going to use all year long and possibly even the rest of your life, you want to buy that closer to the beginning of the year when you're making your plan and actually stick to that plan. Then at the end of the year, what you're going to want to do with this is you're going to want to reassess, hey, what worked last year, right? Did I implement any cost benefit analysis that I did last year? I thought it was going to work out and then it didn't, right? Not everything's going to work out quite as good as you think. All right, there's 3 sections that we're going to focus on here today. The second section is debt rules, right? So there's pretty much 3 debt rules. If you follow these debt rules, you're going to be successful in 2026, especially because we're seeing a reduction in interest rates. So you're going to see all your neighbors out there using debt unwisely. This is going to drive up inflation and the cost of living. And it's also going to be very, very tempting for you to use debt inappropriately. So don't do what your neighbors are doing. Follow these 3 rules. No debt on assets that are not expected to go up over a 5-year timeline. So what that means is you're not going to borrow any money to buy something unless in 5 years that you think that that thing is going to be worth more than it is today. Second thing is no debt on assets that cannot pay for themselves to cover the debt. So if you're buying a business and that business provides cash flow and that cash flow can pay for the debt, you can use that debt. For example, if you're purchasing a real estate asset, right? Does the asset bring in enough income compared to the cost of the debt? Now, if you're doing your own home, you do a cost benefit analysis and you say, hey, how much am I paying in rent? How much am I paying in mortgage? And just remember that not the entire mortgage payment is an expense. Only the portions of interest and insurance and taxes are actual expenses. Your amortization payment is not an expense. That's directly paid towards equity. So you always have to consider that when making a decision to take on debt is your amortization is actually a portion of your equity. That goes towards your total net worth at the end of the year. Rule number 3 is no debt to pay for expenses ever, right? Expenses are things like experiences, food, utilities, any of those needs. We have to source cash from income, not from any other source. So if you do all these 3 things, you're going to do well. One thing I want to cover is vehicles. Vehicles are one of the most tempting areas to take on debt for. And I just recently had a horrific experience in 2025. I had a transmission repair that had to be done on my truck. It's one of those things I could have sold it without doing the transmission repair and gotten pennies on the dollar for my truck. I could have, done that repair and then sold the truck, or I did what I did was I did the repair and kept the truck. There are 2 times when your cost per mile is at its highest. And cost per mile is the most important thing to factor in when making a vehicle purchase, right? Your cost per mile is at its highest the day you buy the vehicle, especially if it's a new vehicle, and right after a major repair. So if you want to reduce your cost per mile after a major repair, you should actually typically keep the vehicle. In most cases, I'm going to say 9 times out of 10, even on a major repair, you're still going to save money. Now, there are always exceptions to this rule, and especially if insurance is paying out because you totaled a vehicle, that's another thing to consider. But if insurance has paid you out, right, don't use that as a down payment on a vehicle and then have a monthly car payment, right? You take that check, you take the cash that you've saved up for your next vehicle, you combine that, you put that into a good used vehicle, or if you can afford a new vehicle, and you hold on to that vehicle for a long time, typically for more than 5 years, you're going to do well by holding a vehicle. If you hold a vehicle for more than 5 years, your depreciation goes down significantly. If you hold a vehicle for more than 10 years, almost 90% of the depreciation is recouped, because the average American is changing out their vehicle every 2 to 4 years. That's just the average, somewhere around 3 years. And that's when the most depreciation happens, is in those first 3 years after buying a new vehicle. So by holding on for 5 years or even 10 years, you're just reducing the amount of depreciation expense that your budget gets to experience. Okay, last thing, let's talk about assets. You have to fill your cup before you go out and chase some of those wants, right? And so your 401k match is always going to be probably your best return on investment if you're an employee. If you're not an employee, you have to go down to your second best, which is owning a home. Owning a home has to be probably one of the highest return on investment decisions you will do over a long-term period of time, right? Short-term period of time we talked about, right? Hey, buying a pressure canner saved my family a ton of money, but it saved my family a ton of money compared to what $175 is. I can't just go out and invest in 30 pressure canners. That's not going to save me any additional money, right? Buying a home is going to save you a lot of money over a long period of time, and it's going to pay dividends every single year, because what happens after a period of inflation, like we're going to have in the next couple of years, most likely, is rents increase. So you get in and you make that cost benefit analysis now based on current rent prices, but as those rents increase, typically your mortgage payment doesn't increase proportionately. So you save a lot of money in the long term there. The third best way that we're going to use our money is in a Roth IRA, and we're going to max out our Roth IRA before we do anything else. Okay. After that, you can get a taxable brokerage account. There's a couple of advantages to having a taxable brokerage account. That taxable brokerage account is to cover certain things that you might want to invest into later, but you may want to access it before you hit retirement age, either 59 and a half or, whatever your account requires you to be in order for you to take it out without any fees or anything like that, right? There's also a health savings account. If you have particular medical issues or specific medical conditions that you're trying to plan for, that might be an individual decision. But for generally speaking, every person pretty much can benefit from having these 4 main account types. Now, owning a home, a lot of people don't understand your true return on investment, right? Typically on your equity in your first year, you're making anywhere between 15 to 20% return on equity. So it's not return on investments, ROE, your ROE. You're making about 1% on your amortization. It's not significant, but hey, it's something to consider. Your cash flow is usually neutral. Maybe you save a little bit of money, but you probably won't in your first year of home ownership. Then the last thing to consider is your taxable benefits, right? Your tax benefits of owning a home are, especially if you're married, you can sell your home for up to $500,000 more than what you purchased it at with no federal capital gains tax. Now, if you live in a state that charges you state capital gains tax, that's completely different. And of course, most counties charge a sales tax, but that is very nominal, very small compared to what capital gains tax is. For example, capital gains tax on a $400,000 gain, if it was not a primary residence, could be roughly anywhere between $80,000 or even well over $100,000 versus on that gain. If you're talking about sales tax, the sales tax might only be $2,000. So it's not really something we worry about when it comes to tax planning. Not saying $2,000 won't affect your budget. I'm just saying typically if you're tax planning over a long-term period of time, like your entire life, over 50 years, we don't really worry about a $2,000 capital, sales tax compared to $100,000 capital gains tax. So just remember, owning a home has amazing tax benefits. So that's why right after the 401k match, owning a home is something that you should heavily consider because it's going to increase the amount of money that you have available to invest later on in your life, right? That's something a lot of people don't consider is, yes, you could just invest that entire down payment now. But if you put it into a home, you're going to well recoup that money. And you're going to be able to put way more money into your other accounts later on. And your Roth is going to be another tax-free source of income. So once your Roth IRA is maxed out, then you can kind of do what you want with your taxable. What are you going to put your money into in a 401k, in a Roth IRA? I'm not a financial advisor, a real estate broker, but consider this point. If you are a homeowner, at some point in time, if you plan on paying off that home and you plan on being debt free, if you plan on living there for over 30 years, which not a lot of people do anymore, but the frugal thing to do would be to live in there until it's paid off completely. Consider the fact that you're going to have this large drop off in expenses. Your expenses might be anywhere from $5,000 a month, $6,000 a month for a family of four. Suddenly you're an empty nester, your kids leave, so you don't have the same grocery expenses. You pay off your mortgage. Your monthly nut to pay for everything that you need might only be a couple $1,000s a month. So consider this. A lot of people overinvest into guaranteed assets like life insurance, annuities, any kind of insurance product or some kind of a bond that pays a guaranteed interest rate or a guaranteed payment, right? If you really want to, you can do the math and figure out what do you need to invest into some of these guaranteed systems in order to pay for that $2,000 a month need. You could if you want to. That's not how I'm personally doing it. And again, this is not financial advice. So I'm telling you at this point, is just what I'm doing. So what I'm doing I don't have a true 401k, but what I'm doing in my Roth IRA as a business owner is that I'm investing in the S&P 500 as an index fund. I do pick a couple of stocks that I've done a lot of research on, and I believe are going to go up over a long-term period of time. And that represents a smaller portion of my retirement account. Then what I do is in my taxable brokerage account, I trade options, some on an index, some on individual stocks. And what I do is I trade enough options to essentially cover the costs of certain things that I really want to pay for right now. and I make sure that I don't attack any of the principal balance. So what that means is if I trade and I have $80,000 that I'm trading and I make, let's just say in a year, I make $20,000, I will only spend minus the taxes on that $20,000, and I will not touch the initial principal balance of $80,000. That's how I manage my trading account. And I want to make sure that that account grows over time to be able to continue to cover the expenses that I want it to cover. So that's what I'm doing, but you can do a wide variety of things in those accounts. I would heavily consider investing in stocks. And there's a reason for that. As interest rates drop, right? At some point in time, the guaranteed rate of return has to drop as well. What does that mean essentially for guaranteed assets like bonds and different things that people use to essentially hedge the stock market? Well, those things go down in value because they're worth less, right? Think of it this way. If you had a bond that was paying you, you paid $100 and it was guaranteeing you $10 a year, but now you have to pay $200 to guarantee $10 a year, right? Essentially, it's not as valuable as another asset that might go up in value 15 to 20%. So you have to take that into consideration when you're making your investment choices. We're in a situation where the Federal Reserve has agreed to have a dovish standpoint on the economy. And what happens in a dovish economy is interest rates go down, asset prices go up. So you don't want to be in a cash economy in 2026, right? Dovish economy means own assets, right? So if you're in a position to buy a home, this is the year to start looking, right? If you're in a position to put a little bit of extra money into some stocks that you really wanted to buy, or whether it's, you wanted to make some advances on your trading account and you want to, bring that to a financial advisor, great, but do not be duped by putting a huge percentage of your savings into guaranteed products like bonds, like annuities, like insurance, right? Find a financial advisor who's actually going to correctly advise you over the next couple of years. Now, at some point in time, a dovish economy has to end, and we will enter into what is called a hawkish economy. A hawkish economy is a cash-advantaged economy where cash is king, right? So assets are queen in a dovish economy. Cash is king in a hawkish economy, right? So we are going into a dovish economy. So you want to own assets right now. Now, if that shifts, at some point in time, hopefully you got a financial advisor that's in your corner, but there's always room after you kind of know that you're on track to retire by a certain age. I would just put the extra cash into a savings account. High yield savings account is, in my opinion, the next priority after that, especially for homeowners. The reason why I say for homeowners is, remember, when you own a home, you're expecting to own this for 30 years, a really long-term period of time. You're expected to benefit over the long run. If something happens to your income, your job, whatever you're using to pay your mortgage over a short-term period of time, you have to have cash to cover that mortgage payment to be able to hold on to that asset. Otherwise, you end up in foreclosure or things like that. So if you own a home, it's more important for you to have, in my opinion, more savings, more cash on hand than a renter would. A renter can get away with having a little bit less cash on hand. The consequences of being late on rent are far smaller than the consequences of being late on mortgage. So if you do have a home, consider also having, I recommend for all homeowners, every single homeowner we talk to at Ethics Realty that we help buy a home, we recommend saving up to that 3-month point. That 3-month is about the time that most people can change jobs, right? If you got fired for a wrongful termination, or if something happened to you, That's kind of the minimum that you want there. 6 months is, in my opinion, puts you in a really strong negotiating point. That's when if somebody says something to you at work that you don't like, right? And you're like, you know what? I don't feel like working here anymore. That's enough time to go find a job on your own terms. That's when when people work for you, right? That's your 6 month kind of savings window. After that, eventually you get into 12 months. 12 months is where you can think about being a business owner. In my opinion, if you're a business owner, you have less than 12 months of liquidity in cash, you're doing something wrong. Because as a business owner, things fluctuate in the market. I do an annual budget as a business owner, right? And I plan for things annually. I don't worry about the day-to-day or the month-to-month. If you're worried about the month-to-month as a business owner, heavily consider getting a part-time job, because at some point in time you will run out of cash as a business owner if you do not have at least, in my opinion, a 1-year security blanket on cash. So with that being said, we're going to wrap up this podcast here. Let me know what you guys think. And if you guys are looking for a home, do not hesitate to give us a call at Ethics Realty, 702-518-1606. You can always visit our website to book an appointment directly at ethicsrealty.net. Thank you for watching and have a great day.
Ethics Realty is a full-service real estate agency that provides a service for finding the ideal property for residential, commercial, and investor-centered clients. Whether you're a first-time buyer or a seasoned buyer or investor, they provide service to all and listen to understand your goals and needs. For more information about their wealth and investment-centered services, call 702-518-1606 or visit their website, ethicsrealty.net. PR Connections Radio thanks you for watching this podcast. Check out more episodes of this show and our others at prconnectionsradio.com.